In the mid-90s, David Bowie, one of the most celebrated and unreadable rock stars on the planet, was in a financial corner. He was a global icon, the man who sold the world, but a huge piece of his life's work didn't actually belong to him. He needed millions and fast to buy back the rights to his own music from an ex-manager who still had a tight grip on his past. Now, another artist might have launched a grueling world tour or maybe banged out a quick commercial album. But Bowie, being Bowie, did something nobody saw coming. He walked onto Wall Street, the heart of global capitalism, with an idea so wild, so out of left field that people thought it was a joke. This is the story of how he walked away with $55 million by inventing a financial tool that turned his creative legacy into a revolutionary asset. It's a tale of how he took the language of high finance, securitization, bonds, asset-backed securities, and bent it to his will, forever changing the power dynamic between artists and the industry that so often exploited them. This wasn't just another famous reinvention. It was a masterstroke of financial self-defense that, for a time, made him untouchable. To really get the genius of Bowie bonds, you have to understand the problem they were built to solve. And that problem had a name: Tony DeFries. Back in the early 1970s, David Bowie was an artist on the verge of greatness, but he was struggling. Critics loved him, but commercially, he was a question mark. That's when he met Tony DeFries, a sharp, ambitious manager who saw the star Bowie could become. DeFries was the architect of the Main Man Management Company, the machine that would launch David Bowie into the stratosphere as Ziggy Stardust. He promised Bowie the world, a machine that would handle all the business, leaving him free to just create. And for that, Bowie, then in his early 20s, signed a contract. It was a deal with the devil, and the devil wore a very sharp suit. The contract gave DeFries a shocking level of control. This wasn't your standard manager's commission. It was a 50-50 split of almost everything: publishing, merchandising, recording revenues. To make it worse, all the massive expenses of the Main Man operation, the lavish tours, the promotion, the sheer spectacle of the Ziggy Stardust era, were billed to Bowie's half of the earnings. So, as Bowie became one of the most famous people on Earth, he was weirdly broke. The more successful he got, the deeper the financial hole seemed to get. By 1975, the relationship had completely imploded. Bowie, tangled in a mess of financial obligations and fighting his own personal demons, had to get out. But breaking up with DeFries and Main Man was brutal. The settlement was almost as punishing as the original contract. 4 years after they split, DeFries kept getting a big slice of Bowie's income, even through Bowie's celebrated Berlin trilogy and the massive success of Let's Dance in 1983. A chunk of the money flowed right back to his old manager. More importantly, DeFries held on to a shared ownership stake in the copyrights of Bowie's most iconic early work. For an artist, this is the ultimate prison. Your own creations, your babies as Bowie called them, aren't really yours. Every time Space Oddity played on the radio, every time an album like Hunky Dory or Ziggy Stardust was sold, someone else was claiming a piece of his soul. By the mid-1990s, Bowie had had enough. He wanted to own his work, all of it. But buying out DeFries' remaining share would cost a fortune. Tens of millions of dollars. This was his gilded cage. He had the fame and the adoration of millions, but he didn't have the one thing he craved most: total control over his own art. He thought about selling his catalog outright, a move many artists are forced into, but he couldn't do it. He couldn't permanently part with his life's work. He needed a different path. A plan that was as creative and unconventional as his music. He needed to get a lot of cash without selling his soul to get it. This is where the story pivots, away from the recording studio and into the boardroom. The solution came from a meeting of two totally different worlds, brought together by two men: David Bowie, the chameleon of rock, and David Pullman, a sharp, innovative investment banker. Pullman was a specialist in a corner of finance that seems hopelessly complex to most of us: securitization. But the basic idea is actually pretty simple. Imagine a bank with thousands of home mortgages. Each mortgage is an asset that generates a steady income stream from monthly payments. Instead of waiting 30 years to collect all that money, the bank can bundle those mortgages together and sell them to investors as a mortgage-backed security. Investors pay a huge pile of cash up front, And in return they get to collect all those mortgage payments for years to come. The bank gets its money now, and the investors get a predictable return. Pullman's brilliant idea was to apply that same logic to something Wall Street had never treated as a real asset: music royalties. He looked at David Bowie's back catalog not as a collection of songs, but as a predictable money-making machine. At the time, Bowie's pre-1990 albums were consistently selling over 1 million copies a year. Every sale, every radio play, every time a song was used in a movie, it generated a royalty payment. Pullman realized this stream of future income was an asset, just like a stream of mortgage payments. It was predictable, consistent, and most importantly, it could be bundled and sold. When Pullman first pitched the idea through Bowie's business manager, Bowie's first question was reportedly, "What's securitization?" But as soon as Pullman explained it, that he could get a massive lump sum of cash now by taking out a loan against his future earnings, without actually selling the rights, Bowie got it instantly. According to Pullman, his reaction was basically, "Why haven't we started yet?" Here was his way out. He could raise the tens of millions he needed to finally buy out Tony DeFries. He could secure his family's financial future. And crucially, he'd do it by leveraging his catalog, not selling it. It was a loan, not a sale. After the loan was paid back, the royalty rights would come right back to him. This was more than just a financial deal, it was a philosophical statement. It declared that an artist's creative work was just as valid a form of collateral as a house or a car. Wall Street initially met the idea with disbelief, even laughter. A portfolio manager for the Wall Street Journal famously asked, "This isn't a joke, is it?" But for Bowie, who had built a career on pushing boundaries, it made perfect sense. He was about to turn his past into the key that would unlock his future. He was about to sell the world, but this time on his own terms. Turning a wild idea into a $55 million check took some serious financial wizardry. David Pullman and Bowie's team had to build something solid enough to convince one of the most conservative groups of investors on Earth to bet on rock and roll. Here's how they forged the Bowie bonds. First, they had to define exactly what was for sale. The asset wasn't the songs themselves, but the river of future royalties they would generate. The collateral for the deal was the revenue from 25 of Bowie's albums recorded before 1990. This was a treasure chest of 287 songs, including some of the most iconic works in music history, like Hunky Dory, The Rise and Fall of Ziggy Stardust and the Spiders from Mars, Heroes, and Let's Dance. This was a proven catalog that had shown it could bring in steady cash year after year. But just pointing to the asset wasn't enough. They had to protect it. To do that, they used a standard tool in these kinds of deals: a special purpose vehicle, or SPV. Think of an SPV as a financial fortress. Bowie legally sold the rights to his future royalties to this new separate company. This was critical because it made the SPV bankruptcy remote. That meant if David Bowie, the person, ever ran into financial trouble, his creditors couldn't touch the assets inside that fortress. The royalties were locked away, legally separate, guaranteeing that the income stream for the bondholders was safe. With the assets secured, Pullman structured the bonds. The deal was for $55 million, with a 10-year average life, meaning the incoming royalties were expected to pay everything off by 2007. To attract a serious investor, the deal had to offer a sweet return. The Bowie bonds were set to pay a fixed interest rate of 7.9%. Back in early 1997, that was a fantastic offer. A 10-year U.S. Treasury note, one of the safest investments in the world, was only paying around 6.37%. The Bowie bonds offered a much bigger payday, which also meant they came with more risk. So how do you convince someone that rock songs are as safe as government debt? The key was getting a credit rating from a major agency. They took the deal to Moody's Investor Service, one of the most respected rating agencies in the world. Moody's dug into the numbers, analyzing the historical sales of Bowie's catalog and the strength of the deal's structure. After their analysis, Moody's gave the Bowie bonds an A3 rating. This was a solid investment-grade rating, a stamp of approval from the financial establishment. It was the moment the deal went from a weird novelty to a serious financial instrument. The A3 rating signaled that, in Moody's expert opinion, the risk of default was low. With a highly rated, high-yield bond on the table, Pullman didn't have to look far. The entire $55 million issue was snapped up in a private sale by a single buyer, the Prudential Insurance Company of America. This was maybe the most stunning validation of the whole concept. Prudential wasn't some risky venture capital firm. It was one of the biggest, most conservative insurance companies out there. For a company that builds its entire business on carefully managing long-term risk, to put $55 million into a deal backed by rock music was revolutionary. It proved they believed in the core idea, that the future earnings of a great work of art were a stable and predictable asset. The fact that Prudential bought the whole thing meant Bowie got all his money in one clean shot. The deal was done. David Bowie had turned future stardust into cold, hard cash. He had borrowed from his own future, using the language of Wall Street to win his freedom. He didn't just play their game. He invented a new one. The successful launch of the Bowie bonds in early 1997 was a huge win for David Bowie, both financially and artistically. With the $55 million from Prudential in hand, he could finally make the moves that inspired the whole crazy venture in the first place. Job one was reclaiming his past. Bowie used a huge chunk of the money. Reports suggest it was between $27 and $30 million to buy out Tony DeFree's remaining stake in his catalog. After nearly 3 decades, the punishing financial deal that had haunted him since his early days was finally over. For the first time, he was the sole owner of his entire pre-1990 body of work. The songs, the albums, the legacy, it was all his. The gilded cage was finally unlocked. Beyond that main goal, the $55 million provided a kind of financial freedom he'd never had before. Instead of waiting for royalty checks to trickle in over a decade, he had a mountain of cash right away. This allowed for savvy estate planning and the ability to make other investments, reportedly including in the booming world of internet companies. There were also some nice tax advantages. By getting the money as proceeds from a bond sale, which is basically a loan, he could manage his tax liability much more effectively than if he had just received it as royalty income year after year. For the 10-year life of the bonds, of course, he gave up the royalty income from those 25 albums. That money now went to Prudential to pay their 7.9% interest and repay the loan. But that was a price he was more than willing to pay. He had traded a decade of passive income for immediate freedom and total ownership of his art. It was a strategic move that put him in an unheard-of position of power over his own career. He had walked into the lion's den of Wall Street and came out not just unscathed but stronger. He proved that an artist's intellectual property was a bankable asset, and in doing so, he created a blueprint for others to follow. The man who fell to earth had just conquered a whole new world: finance. This story of financial and artistic liberation is a testament to Bowie's genius. If you're finding this deep dive into the intersection of music and finance fascinating, and want to see more stories about innovators who changed the game, take a quick moment to hit that subscribe button. It helps us create more content just like this. The Bowie bonds were engineered with the precision of a Swiss watch, all based on one big assumption: that the music industry's business model, stable for decades, would stay that way. The bond's value was tied directly to the predictable flow of royalties from album sales. But just a couple of years after the ink dried on the deal, an earthquake hit the music industry, and its name was Napster. Starting around 1999, the explosion of peer-to-peer file-sharing platforms unleashed a tsunami of digital piracy. All of a sudden, music was free. Listeners who used to buy CDs could now download entire albums in minutes, and the industry had no idea what hit it. Album sales, the very foundation of the Bowie bonds' financial projections, started to collapse across the board. What's amazing is that Bowie himself saw this coming. In a 2002 interview with the New York Times, he basically predicted the whole seismic shift. He said, "I don't even know why I would want to be on a record label in 10 years' time. Music itself is going to become like running water or electricity." His prophecy was proving terrifyingly accurate. The weakness in sales for recorded music, as a Moody's spokesperson later put it, hit the revenue stream backing the bonds hard. The cash flow was lower than expected, and Wall Street, which values predictability above all else, started to get nervous. That nervousness became official in March 2004. Moody's Investors Service, the same agency that gave the bonds that shiny A3 rating, issued a stark warning. They downgraded the Bowie bonds to BA3. While still technically investment grade, BA3 was just one single step above junk status. This was a huge deal. The bonds that were once seen as a sexy, solid investment were now looking a lot riskier. The downgrade sent a shiver through the financial world and made major headlines. It looked like the grand experiment might be failing. Skeptics who had doubted the deal from the start felt like they were being proven right. The story changed. Had Bowie's brilliant financial move been wrecked by a couple of teenagers in a dorm room? The storm he saw on the horizon was now threatening to sink his revolutionary ship. The big question was whether the bonds would survive, or if they would default, costing Prudential millions and staining Bowie's financial legacy. Despite the downgrade, the media hype, and the very real crisis swallowing the music industry, the story of the Bowie bonds does not end in failure. In fact, what happened next is maybe the most impressive part of the whole tale. The Moody's downgrade to BA3 was a warning of higher risk, not a sign of default. It just reflected the undeniable fact that royalty money was coming in slower than originally projected back in the pre-Napster world. This meant the investment was less secure than Prudential had bargained for. If Prudential had tried to sell the bonds after 2004, they probably would have lost money. But Prudential held on. And the structure David Pullman had designed proved to be tough. The royalty stream, while smaller, never ran dry. The timeless appeal of Bowie's catalog kept generating cash, and every single payment to the bondholders was made on time. In 2007, exactly 10 years after they were issued, the Bowie bonds reached full maturity. They were completely paid off without a single default. Prudential got all its money back, plus the promised 7.9% interest it had earned over the decade. The ship had made it through the storm. And with that final payment, the most beautiful part of the whole arrangement kicked in. The rights to the royalty streams from all 287 songs went right back to David Bowie. The deal was done. It had worked perfectly for everyone. David Bowie won. He got his $55 million upfront, used it to take back his catalog from his ex-manager, and after 10 years he got the full income stream from his life's work back. He timed his move with almost supernatural precision, cashing in on his assets at their peak value right before the market was turned upside down. Prudential won. Despite the midterm scare, they got the full 7.9% return they were promised, a much better yield than they would have gotten from safer government bonds. The concept won. The Bowie bonds proved that intellectual property could be the foundation for a successful, large-scale financial deal, even when faced with a worst-case scenario. The successful end of the Bowie bonds in 2007, right before the 2008 global financial crisis would have torched the deal, cemented their legendary status. They weren't a failed gimmick. They were a pioneering financial tool that had been stress-tested by a perfect storm and survived intact. Bowie hadn't just made a clever deal, he had created a masterpiece of financial resilience. The immediate effect of the Bowie bonds was a little flurry of copycat deals, often put together by David Pullman himself and nicknamed Pullman bonds. Artists with deep and valuable catalogs, like the godfather of soul James Brown, heavy metal legends Iron Maiden, and the Motown hit-making team Holland Dozier Holland, all followed Bowie's blueprint, issuing bonds backed by their future royalties. For a hot minute there at the end of the 90s, it looked like a new age of artist financing had begun. But the Napster apocalypse put a quick stop to that first wave. With album sales in a nosedive, the predictable royalty streams vanished, and investors got cold feet. The market for celebrity bonds dried up almost as fast as it appeared. For more than a decade, the Bowie bond was seen as a brilliant, one-of-a-kind moment. But then, the music industry started to reinvent itself. Out of the chaos of piracy, a new, more stable model emerged: streaming. Platforms like Spotify and Apple Music turn music from a product you buy into a utility you subscribe to, exactly as Bowie had predicted. This changed everything for royalties. Suddenly, income wasn't based on the whim of a kid buying a CD, but on millions of subscribers paying a fee every single month. The data from these platforms made royalty income predictable again. In fact, more predictable than ever. This new stability breathed new life into Bowie's invention. The financial world took notice again, and this time it wasn't just a few deals. It was an explosion. What Bowie pioneered has now become a mainstream multi-billion-dollar asset class. Today, the market for music catalog finance is booming. The global market was valued at an estimated $7.2 billion in 2024 and is projected to soar to $18.5 billion by 2033. Streaming now provides the vast majority of music revenue, creating the stable, scalable cash flows that investors love. And it's not just insurance companies anymore. Some of the biggest names in private equity have jumped in, viewing music rights as a recession-proof asset that doesn't follow the ups and downs of the stock market. The investment giant Blackstone has become a major player, partnering with the Hipgnosis Songs Fund to acquire massive music catalogs. In 2024, Blackstone completed its acquisition of Hipgnosis for around $1.6 billion, and then used those assets, including songs by Justin Bieber and Shakira, to back a massive $1.47 billion bond deal. Other giants like KKR and Concord have raised billions through similar debt financing, all based on the same basic principle Bowie and Pullman proved out. In 2025, Concord closed a record-breaking $1.76 billion securitization deal of its own. One key difference in this modern gold rush is worth noting. Many of the huge deals you read about today, like those for Bob Dylan or Bruce Springsteen, are outright sales of their entire catalogs. They are trading ownership for one last giant payday. Bowie's original deal was arguably more artist-friendly. It was a loan, not a sale. He used his catalog as collateral to get cash while making sure he would ultimately keep ownership. He figured out how to have his cake and eat it, too. Still, every time you read about a private equity firm buying a music catalog or an artist securitizing their royalties, you're seeing the direct legacy of the Bowie bonds. They were the proof of concept, the deal that showed the world the immense financial power locked inside art. In the end, the story of the Bowie bonds is about way more than just a financial transaction. It's a story about power, control, and the enduring value of great art. At a time when he was trapped by his own success, David Bowie refused to be a victim of the system. Instead of complaining about it, he learned its language and forced it to work for him. He saw his catalog of songs not just as cultural treasures, but as a portfolio of high-performing assets. He took the strange tools of Wall Street and used them to forge his own freedom. The $55 million deal he struck was a work of genius, a move with such incredible timing that it let him pull maximum value from his work just moments before the digital revolution blew up the whole business model. He secured his fortune and, more importantly, he secured ownership of his life's work. Today, the financial instrument he pioneered has grown into a thriving billion-dollar market that's changing the economics of the entire music industry. It stands as one of his most important, yet least understood, acts of reinvention. David Bowie was a musical visionary, a fashion icon, and a cultural force. But with the Bowie bonds, he proved he was one more thing. A financial revolutionary who composed a masterpiece not with a guitar, but with a prospectus. He sold the world, and in doing so, he taught a generation of artists how they could own it. What do you think was Bowie's most revolutionary act? Let me know in the comments below. And if you enjoyed this story, don't forget to like this video and subscribe for more deep dives into the lives of innovators who changed our world. Thanks for watching.